So ultimately the agents and the pundits and some economists that say this time it's different, okay? The marketplace can't possibly price correct too dramatically because supply is severely low, okay? But here's the thing, okay? What can change supply and what can change supply chain quickly? Those are the risks to the marketplace. And when you think about the fact that there is low supply, renting is still record highs, particularly in Central Florida. The reality is, if you have a challenge in the marketplace where recession really starts to anchor in, okay? One of my biggest concerns is what will change the marketplace further, okay? The Fed is still not getting a handle on the inflation, right? It shouldn't be a real shock to anybody, by the way. It's like, wow, they've really adjusted interest rates. Well, in the past, when the Fed went to fight inflation, they did much higher increases than what we're seeing now. These are little drops in the bucket. Like the economists that are watching this, if you watch economists with time on them, they're looking at this early on going, they're doing something, but this is like a fire out of control and you're like bringing a tiny little bucket of water with these little interest rate increases. So we're not doing enough. The interest rates are still climbing, and yet we have most likely, because the inflation is not getting under control, a trajectory of higher and higher interest rates, okay? So what we're seeing in Central Florida, and this is probably very, much similar throughout the country, is that the people that are still firing bullets at these houses, these last few buyers that are still in the marketplace, who are they? They're buyers with cash. Okay, I'm seeing them. The ones that are coming and still placing offers on our properties, they're ones with cash. We've seen the hedge funds backing up a little bit. I've seen hedge funds canceling contracts because I saw one particular hedge fund that had 50 offers accepted. They're buying and buying and buying. They had a wave of 50 offers come out and get accepted, which was hard to do back in April. And they walked away on nearly all of them. They lost like $150,000 in earnest money deposits, just left them on the table. You're seeing these interest rates, obviously a lot of the hedge funds, a lot of the funds in general, corporate buyers, let's say, those people are using leverage. So whenever the interest rates start growing, then the marketplace starts increasing rate of interest even for corporate investors that are buying these homes and levering them with financing. That's messing up the ROI, okay? Even with these record high rents. It's changing things. So those buyers that were institutional, that were making all this noise, BlackRock's buying up everything and all these, you got to understand, a lot of them are leveraging, okay? What they're not leveraging, they're getting from the marketplace in terms of investment, right? Like how much more investment are we going to get on housing through REITs and all these people that want to back companies to buy more houses? How much more investment is going to come if they think that there's potential capital loss through deflation of the housing market? Like there's a point where people are just, it's like common consensus. They see it on every news channel that the housing market may be backing away. It might be coming down. It's definitely resetting. It's balancing. And so that kind of money just chills out and waits. Most of the offers that we're getting, however, right now are people coming out of another house. They're coming from somewhere else, right? Because who in the world is going to sell their house at $300,000 and say they want to move up to $400,000? They're selling a house that had a better interest rate at $300,000 to go to a $400,000 interest rate that might be 1 or 2% higher. I mean, getting the extra pool now, like let's say you're selling from 300 to 400 or 400 to 500 to get a pool, you get a soured interest rate, and then the pool ends up costing you what, $1,000 a month more or $1,500 a month more in mortgage payment because you jumped in payment to get some better set up house. I mean, a lot of people, if you look at it honestly, you think that the marketplace is probably going to see an increase in, maybe some remodeling and things of that nature. But even that is going to be tricky because, remodeling has its own cost. Cash out refinances, right? People borrowing out of their equity to fix the house they live in and add the pool is coming at higher terms. So we're seeing cash out refinances just like boom, they're just going down and they're losing steam. The reason why the buyer demand disappeared is because you had all these people that, let's say they were trying to buy for the last year. Because this is what happened. When you're in a pack of 50 buyers trying to buy the same house, you got pre-approved a year ago and you tried and tried and tried again, and a year went by and you didn't buy anything. Then all of a sudden the interest rate goes up like 3 percentage points, 3 in some cases 4% over months of time, okay? So like you had a 3%, a 3.5% go to 6.5%. That affected the housing market by $600 a month. The average 20% down buyer is now paying $600 more a month for the same property, okay? $600 a month, by the way, in buying power is $100,000, okay? So the interest rate change in that scenario is $100,000 of buying power. So if you were maxed out, the lender said you have a $400,000 pre-approval to buy a house, that new interest rate could be given to you, and then you're like, oh, you're now at $300,000. Now think about that. You've tried to buy for a year, and $400,000 has, that doesn't even buy anything anymore in your mind. You're like, psychologically, man, I've been trying for a year. A year ago, I could have got a pool and a 1,500 square foot house. Now I can only get a 1,400 square foot house with no pool for $400,000. And then the lender says, by the way, you get to buy $100,000 less to qualify. That brought a ton of people out of the market. And a lot of real estate agents, a lot of professionals saying, well, you know what? It's just sticker shock. They're gonna step back, they're gonna calibrate, and they're gonna come back. And if you're paying attention to the marketplace right now, the Fed is not getting a handle on inflation. That means people are struggling to buy food, to put gas in their car, and to pay their mortgage or their rent, okay? You have a lot of major companies, the banks, particularly Bank of America, just recently came back and adjusted their GDP outlook, saying we're going into recession. It's going to be negative numbers, okay? So if the Fed is increasing the cost of things and the bubbles are popping, you got to understand what happens to an economy in that. Let's be honest with ourselves. Do people get more jobs? Do they get more raises? Do they get more advancement? Or does the company start cutting and laying people off? And we're already seeing the layoffs coming. So the reality is, if people start to have challenges in paying for their mortgages, then what is going to happen? It's going to drive them to sell their home, okay? The other thing too is if people start to get very nervous about the future of their livelihood and they feel like they're too house poor, they feel like the house is obligating too much of their own money, and they know most of their financial wealth is tied up into their house, they might do what? They're going to cash in. They're going to sell, which in reality, my view, okay, my professional view is that the next wave of housing supply comes from builders reducing prices to sell, okay? That's gonna happen. Builders will not get stuck on property. The second thing is I think you're gonna continue to see housing starts diminish, okay? Great, that means there are gonna be less houses that are sitting without buyers because buyer demand is super low. We don't need a ton of houses right now. Here it is. But the next thing is you're gonna have some circumstances where people that have really bought in high at the very end, and we start to see some receding of the marketplace. I mean, I'm telling you folks, some of these areas went up way too fast. I've seen markets in Florida that these properties were like 180 a year and a half ago that are in the mid threes now, okay? So all of a sudden buyers disappear. People have to sell in those communities. Some of those people, like the builders, can afford to come down from 300 to 260. Well, your neighbor paid $310 5 months ago and now can't afford to hold the place. Do they all lease them out? Do they say to themselves, like I bought in pretty high, I need to get as much cash out of this as I can, I'm in financial trouble. And in some cases, they don't have any outlook but to short sell the property. What I think you're gonna see by the third quarter of 2023 is certain areas that were less appealing. You're gonna start to see short sales in those areas. If recession still becomes more of a factor going forward, we have negative GDP numbers, we have more Fed interest rate hikes, you're gonna see more defaults, which by the way, they're record low right now. Most people are not in default. Most people have equity in their home. And I would say nearly no one is in a negative equity position right now. But when you have no demand and you have potential for supply increases, it's easy for prices to roll back. If demand starts coming down, it has an impact on prices. Obviously, the fact is right now, there's not a lot of supply. That's the good news, is there's not a lot of supply to affect the fact there's low demand. But what happens next? Like if you're reading what's going on, then we will see some distressed property. I think you will see short sales in the coming quarters, not around the corner, but I think by late summer, fall of 23, we'll see a lot of short sales in some spots.